The modern financial market is a world of algorithms, high-frequency trading, and an endless, overwhelming stream of global information. It appears to be a complex, futuristic arena far removed from the wood-paneled brokerage houses and chaotic trading pits of a century ago. Yet for all its technological advancement, the market is driven by the same timeless engine: human psychology. The primal, unchanging forces of greed and fear that governed the decisions of speculators in the Gilded Age are the very same forces that drive the volatility of today. It is for this reason that the most powerful and enduring rules of the game were not written in code, but were forged in an era of raw, unregulated capitalism by the men who first mastered its brutal logic. This is not a history lesson. It is a deconstruction of the unwritten code, the hard-won principles of the market's founding fathers. While others chased tips and followed the herd, these operators developed a set of unspoken rules based on a deep, often cynical understanding of market dynamics and human nature. We will dissect 7 of these rules, beginning in this section with the 4 foundational principles that govern the mindset, the analysis, the strategy, and the execution of a master speculator from this classic era. Rule number 1: the public is always and everywhere wrong. James R. Keene. Before an operator can develop a strategy, they must first establish a worldview, a fundamental belief about the nature of the market they are entering. For the great speculators of the Gilded Age, the first and most important article of faith was a profound and unwavering skepticism of the crowd. No one embodied this cynical realism more than James R. Keene, a man known as the Silver Fox of Wall Street. Keene was not a passive investor. He was a legendary stock pool operator, a master strategist who engineered some of the most famous market campaigns of the late 19th and early 20th centuries. His entire operational philosophy was built on a simple, brutal, and highly profitable premise: the public is always and everywhere wrong. This is not the same as simple contrarianism. A simple contrarian might buy a stock just because it is falling, or sell one just because it is rising. Keene's principle was deeper and more strategic. He understood that the public, the collective mass of amateur market participants, does not act on logic, but on emotion. They are driven by the 2 great forces of greed and fear. They buy at the top of a market, in a state of euphoria, driven by the fear of missing out on easy profits. And they sell at the bottom, in a state of panic, driven by the fear of total ruin. Their actions are always most extreme, and therefore most predictable, at the major turning points of a market cycle. For Keene, the public was not a collection of independent thinkers. It was a herd, and a herd is a force of nature that can be studied, anticipated, and exploited. His life's work was the practical application of this rule. As a pool operator, his job was to accumulate a massive position in a stock quietly, and then to engineer a public frenzy to drive the price up so he could sell his shares to the euphoric crowd at a massive profit. He would use every tool at his disposal, planting bullish stories in the press, spreading tips through networks of brokers, and creating the illusion of heavy buying on the ticker tape, to whip the public into a buying panic. He was, in essence, creating the consensus. And once that consensus was absolute, once the public was fully committed and clamoring for more shares at any price, he knew with certainty that the top was near. He would then begin to methodically distribute his holdings to the very herd he had cultivated. His rule was not just a passive observation. It was an active operational strategy. It was a recognition that the path to great profits lay not in following the crowd, but in understanding its predictable irrationality and positioning oneself to be on the other side of its greatest emotional mistakes. Rule number 2: judge the market by its own action, not by the news. Richard Wyckoff. If the first rule establishes a necessary skepticism towards the crowd, the second establishes a similar skepticism towards the publicly available information that the crowd consumes. Richard Wyckoff, the great market journalist and analyst who spent his life decoding the methods of operators like Keene and Livermore, codified this principle perfectly. He insisted that a successful operator must learn to judge the market by its own action, and not by the news that is printed in the papers. This is the foundational principle of all tape reading, a discipline built on the belief that the ticker tape, the real-time record of price and volume, is the only source of objective truth. In the Gilded Age as it is today, the public was obsessed with the news. A bullish headline about a company's earnings or a new invention was seen as a clear signal to buy. A bearish story about the economy was seen as a signal to sell. Wyckoff, through his decades of observation from his privileged position at the center of Wall Street, knew that this was a fatal error. He understood the concept of discounting, the idea that by the time a piece of news becomes public, its impact has almost always already been reflected in the stock's price. The smart money, the informed insiders and large operators, act on information and rumors long before they reach the front page of a newspaper. They accumulate their positions in anticipation of good news and distribute their holdings in anticipation of bad news. Therefore, the news itself is not the signal. The market's reaction to the news is the signal. This is a critical distinction. A truly professional operator uses the news as a tool to gauge the market's internal condition. For example, if a company releases a spectacular earnings report and the stock's price opens higher, but then closes down for the day on heavy volume, the first-level thinker is confused. The news was good, but the stock went down. The Wyckoff analyst, however, sees the truth with perfect clarity. The good news was used by the large, informed operators as the perfect opportunity to unload their shares to an excited public. The heavy volume and poor price close reveal a state of active distribution. The action of the market has revealed the truth, while the news has obscured it. Conversely, if a market weathers a barrage of terrible news without declining, it is a powerful sign that all the potential sellers have already sold, and that the market is in a state of accumulation. Wyckoff's rule forces the analyst to adopt a clinical, evidence-based approach, trusting only the objective data of price and volume and viewing all news and narratives with the healthy skepticism of a detective who knows that every witness has an agenda. This focus on objective evidence over emotional narratives is a core habit of all great market operators. It is a discipline that must be cultivated, a way of thinking that separates the professional from the amateur. To continue forging these professional-grade habits of thought, and to learn the timeless principles of the market's masters, we invite you to subscribe to this channel and click the notification bell. Rule number 3. Control the supply and you control the price. J. Gould. While Keene and Wyckoff were masters of interpreting and exploiting the market as it was, our next figure operated on a different plane entirely. J. Gould, one of the most brilliant and feared financiers of the 19th century, was not content to simply play the game. His strategy was to fundamentally alter the rules of the game to his own advantage. His unspoken rule, demonstrated repeatedly throughout his career, was this: control the supply and you control the price. This is a principle that transcends mere trading and enters the realm of corporate and economic warfare. It is based on the simple economic reality that the price of any asset is a function of its supply. If an operator can gain control over the majority of the available, or floating, supply of a stock or commodity, they can create an artificial scarcity and effectively dictate the price. This strategy was most famously employed in the tactic known as cornering the market. A corner involves an operator or a syndicate quietly buying up as much of the available supply of a security as possible. At the same time, they encourage other speculators, particularly the bears, to sell the stock short. A short seller borrows shares they do not own and sells them, hoping to buy them back later at a lower price. But in a corner, there is no lower price. Once the operator has control of the supply, they can begin to drive the price up dramatically. The short sellers are now trapped. To close their positions, they are forced to buy back the shares they borrowed, but the only person with shares to sell is the very operator who engineered the corner. The operator can then name their price, forcing the shorts into bankruptcy and reaping an enormous profit. Gould's most audacious and infamous attempt to apply this principle on a grand scale was his plan to corner the gold market in 1869, an event that would culminate in the financial panic known as Black Friday. Gould's thesis was that if the U.S. government could be persuaded to stop selling its own gold reserves on the open market, he and his partner, James Fisk, could buy up the limited available private supply. They believed that a higher price for gold would lead to a higher price for agricultural goods, which would benefit the nation's farmers and the railroads that Gould controlled. He used his political connections to lobby President Ulysses S. Grant directly, all while his agents were quietly buying up massive amounts of gold in the New York gold room. As he gained control of the supply, the price of gold began to soar, and the short sellers who had bet against him were squeezed. The scheme, however, came to a dramatic end when the Grant administration, realizing it was being manipulated, ordered the Treasury to sell a large amount of government gold, breaking the corner and causing the price to collapse on Friday, September 24th. While Gould himself, having been tipped off, managed to escape with his profits, the ensuing crash ruined countless other speculators and created a severe economic disruption. The episode, while a dark chapter in financial history, is a powerful illustration of this unspoken rule. It demonstrates a level of strategic thinking that goes far beyond simple tape reading, focusing instead on the fundamental structural drivers of an asset's price. Rule number 4. Never meet a margin call. Jesse Livermore. From the grand, strategic world of market control, we now turn to the most critical, personal, and non-negotiable rule of survival for the individual speculator. This principle was championed by the greatest speculator of them all, Jesse Livermore. His rule was absolute: never meet a margin call. This is not simply a stop-loss rule. It is an ironclad law of self-preservation, a final, definitive line in the sand between a manageable loss and total ruin. To understand this rule, one must first understand the nature of margin. Trading on margin is the practice of borrowing money from a broker to control a larger position than one's own capital would allow. It is a powerful tool of leverage, capable of amplifying both gains and losses. A margin call occurs when a leveraged position moves against a trader to the point where their own capital is no longer sufficient to cover the potential loss. The broker demands that the trader either deposit more cash into their account to meet the new, higher collateral requirement, or the broker will forcibly liquidate the position. The amateur, driven by hope and an unwillingness to accept a large loss, is often tempted to meet the margin call by sending more money to their broker. For Livermore, this was the single most fatal error a speculator could make. He viewed a margin call not as a temporary problem, but as the market's final definitive judgment that your initial thesis was catastrophically wrong. It was an undeniable signal that you were on the wrong side of the market's primary trend. To add more money to the position was an act of pure, unadulterated hope, a doubling down on a failed idea. It was, in his words, throwing good money after bad. He knew that this was the path of the gambler, not the professional operator. His rule was a surgical amputation of hope from the trading process. The moment a margin call was issued, the thinking was over. The position was to be closed immediately. The loss, no matter how painful, was to be taken. This was the only way to preserve the most important asset a speculator has, their remaining capital, and the clear, unemotional mind required to use it on the next, better opportunity. To truly master this level of psychological discipline, one must first understand the enemy, the raw, powerful emotions that drive speculative markets. There is only one book ever written that captures this internal battle with perfect, brutal honesty. That book is Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not a dry textbook of strategies. It is a living document, a direct look into the mind of its protagonist, Larry Livingston, the thinly veiled prototype of Jesse Livermore himself. It is a book that transcends time because it decodes the unchanging nature of markets and men, revealing the timeless psychological traps of fear, hope, and greed that have destroyed speculators for centuries. But how can a century-old text be applied in today's high-speed markets? The original wisdom, while profound, can feel distant. For this reason, the single most valuable resource for the modern operator is the new 2025 Annotated edition, Reminiscences of a Stock Operator, an in-depth, chapter-by-chapter analysis for the modern speculator by Max Davidson. This is not just the original text. It is a complete translation of its timeless wisdom. Max Davidson's detailed commentary in each chapter acts as a bridge across the century, making every one of Livermore's hard-won lessons immediately powerful and accessible for the trader of today. A link to this essential edition has been provided for you in the description below. It is the definitive guide to the psychology that every Gilded Age master had to conquer. Rule number 5. Always hunt for the reason why things are so. Bernard Baruch. If our last rule from Jesse Livermore was a testament to the absolute necessity of disciplined risk management, our 5th rule, from his contemporary Bernard Baruch, is a testament to the intellectual rigor required to even place a bet in the first place. Baruch, the legendary lone wolf of Wall Street, operated with a famous rule to get the facts. But this was merely a surface-level description of a much deeper, more profound principle. His true unspoken rule was to be always hunting for the reason why things are so. This is a subtle but critical distinction. Getting the facts is an act of collection. Hunting for the reason why is an act of deep causal analysis. It is the relentless pursuit of the fundamental drivers behind a market movement, a process of asking why until one arrives at the bedrock of a situation. This principle was the engine of Baruch's intellectual self-reliance. He was deeply skeptical of surface-level explanations. If a stock was rising, he was not content to simply accept that there were more buyers than sellers. He needed to know why there were more buyers. What fundamental change in the company's business, its industry, or the broader economy was causing this shift in the supply and demand equation? This relentless curiosity was his primary form of risk management. It protected him from being swept up in purely speculative manias that had no underlying fundamental basis. If he could not identify a clear, logical, and fact-based reason for a market move, he would not participate no matter how tempting the price action appeared. His investment in the American Sulphur Company is a masterclass in this principle. He became interested in the company but did not simply buy the stock. He embarked on a deep investigation into the entire global sulfur market. He learned about the revolutionary new frash process, a technological breakthrough that allowed for the cheap extraction of sulfur from underground deposits in Texas, where the company had a near monopoly. He then studied the industries that depended on sulfur, particularly in the production of rubber and newsprint, and saw that global demand was set to explode. He traveled to Texas to see the operations for himself. By the time he was done, he understood the fundamental causal chain. A new technology had unlocked a massive low-cost supply, controlled by one company. At the exact moment global demand for that supply was entering a period of exponential growth, he had found the reason why. This deep foundational understanding gave him the immense conviction to take a massive position, a bet that would earn him his first $1 million. This approach stands in stark contrast to the first-level thinking of the average speculator, who is content to trade on patterns and rumors. Baruch's rule demands that an operator go deeper, to understand the entire ecosystem of an investment. It is a commitment to the hard intellectual work of cause and effect analysis. It is the understanding that a durable edge in the markets comes not from having a better guess about the future, but from having a superior understanding of the present. Rule number 6. Never be a bear on the United States. Cornelius Vanderbilt. Our 6th unspoken rule comes from one of the founding fathers of American capitalism, a figure who predated even the Gilded Age operators, Commodore Cornelius Vanderbilt. Vanderbilt was not a stock trader in the modern sense. He was a builder of empires, first in shipping and then most famously in railroads. He used the stock market not as a casino for short-term bets, but as an arena for corporate warfare, a tool for consolidating industries and building monopolies. His entire operational career, however, was guided by a single, powerful, long-term strategic principle, which he articulated near the end of his life. Never be a bear on the United States. This is not a call for blind, naive optimism. It is a profound, strategic bias based on a deep-seated belief in the long-term structural growth trajectory of a dynamic, innovative, and capitalist economy. Vanderbilt had witnessed America's explosive growth firsthand, from a young nation of scattered states into a continental industrial powerhouse. He understood that while the country would undoubtedly face setbacks, panics, depressions, and civil war, the primary inexorable trend was one of expansion, innovation, and the creation of wealth. His rule was a directive to distinguish the long-term primary tide of American growth from the short-term secondary waves of market panics and recessions. The strategic implications of this worldview are immense. It meant that for Vanderbilt, crises were not threats to be feared. They were massive generational buying opportunities. While other, less strategic operators were wiped out by fear and forced selling during market panics, Vanderbilt, with his vast capital reserves and long-term vision, would step into the wreckage. He used these moments of maximum pessimism to consolidate his power, to buy up rival railroad lines and other valuable assets for pennies on the dollar. He was not timing the bottom. He was acting on his fundamental belief that any bet against the long-term prosperity of the nation would ultimately be a losing one. While he was a long-term bull on the system, he was a ruthless bear on his individual competitors. The epic, eerie War of 1868 showcases this duality. Vanderbilt, in his attempt to consolidate the railroads leading into New York City, sought to take control of the Erie Railroad. He was opposed by the infamous trio of Daniel Drew, Jay Gould, and James Fisk, who controlled the Erie. The battle that ensued was one of the most outrageous in financial history, involving brazen stock manipulation, the illegal printing of tens of thousands of new shares by the Erie directors to dilute Vanderbilt's holdings, the bribery of judges and legislators, and a literal chase across state lines. Vanderbilt ultimately lost that specific battle, but his broader strategic principle was proven right. He was always fighting to build and consolidate, betting on the eventual growth of a rationalized, powerful transportation system. His long-term vision, his strategic bullishness on the American enterprise, is what allowed him to build an empire that would last for generations, far outliving the short-term profits of his more purely speculative rivals. Rule number 7. The market is made by the minds of men. Charles Dow. We arrive at the final and most profound unspoken rule, a principle that serves as the philosophical foundation for all the others. It comes from Charles Dow, the quiet journalist who sought to understand the market's very soul. While his theory is known for its practical tenets, his most important and least discussed insight was a simple, powerful observation. The market is made by the minds of men. This is the ultimate truth of financial markets. The market is not a machine, it is not a mathematical equation, and it is not an entity with its own independent consciousness. It is a human construct, a massive global reflection of collective human psychology. All of the patterns, all of the trends, all of the bubbles, and all of the crashes that we observe are nothing more than the graphical representation of the immutable human emotions of hope, fear, and greed playing out on a massive scale. This rule is the unifying theory that connects all the other principles of the Gilded Age masters. James R. Keene's cynicism about the public was based on his understanding that the minds of men in a crowd are prone to predictable emotional folly. Richard Wyckoff's insistence on reading the tape was an understanding that the tape was the most direct, unfiltered record of the actions of those minds. Jesse Livermore's rules on emotional control were a recognition that to succeed, He had to conquer the flawed, primal instincts of his own mind. Bernard Baruch's hunt for the reason why was a search for the logical underpinnings that could, at times, override the purely emotional decisions of the market's participants. Dow's own theory is the ultimate expression of this principle. The three phases of a primary trend are not technical events. They are a three-act psychological drama. The accumulation phase is a story of a few astute minds buying from a public consumed by the fear and despair left over from a previous bear market. The public participation phase is a story of growing hope and confidence as business conditions improve. And the distribution phase is a story of rampant, irrational greed, where the astute minds of the accumulation phase sell their holdings to a euphoric public. The confirmation of the averages is not just about numbers. It's about checking if the real physical economy, the actions of men in transport and industry, psychologically supports the speculative optimism seen in the financial markets. Volume is the measure of emotional intensity, the fuel of conviction behind a move. This timeless insight is what makes the study of these century-old masters so essential. The technology has changed, the instruments have changed, and the speed of information has changed beyond recognition. But the machine that all this technology is built upon, the human brain, has not changed at all. The minds of men are still driven by the same powerful, primal, and often irrational emotions. This is why history rhymes in the financial markets. It is why the patterns of booms and busts, of manias and panics, repeat themselves with such frustrating regularity. The final unspoken rule is that to master the markets, one must first and foremost be a student of human nature. In conclusion, the 7 unspoken rules of the Gilded Age market masters form a complete, if unwritten, code of conduct for the serious speculator. In reviewing them, a powerful theme emerges. Keene's cynicism, Wyckoff's objectivism, Gould's strategic aggression, Livermore's ruthless execution, Baruch's intellectual curiosity, Vanderbilt's long-term vision, and Dow's psychological insight, they all point to a single unifying truth. These men, operating in the most brutally competitive environment imaginable, understood that the market was not about stocks or bonds or commodities. It was about people. It was about understanding the motivations, the fears, and the predictable follies of their competitors and the public at large. They mastered the game not by finding a secret formula, but by first mastering their understanding of human nature, and most critically by mastering themselves. Building a successful system is about building the right habits. The philosophy of these Gilded Age masters is not an abstract theory. It is a set of principles that requires the cultivation of disciplined habits of analysis, courageous execution, and ruthless risk management. If you are serious about developing these professional-grade habits, subscribe to this channel and click the notification bell. Let this be the place you come to forge the intellectual framework that will define your future in the markets.